We're jumping straight into energy fuels today. Everyone is watching the price action, but the real story is the massive push for domestic uranium and rare earth processing.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And before we get into the heavy mechanics driving all this volatility, make sure you subscribe and hit the like button. It really helps us keep bringing you this level of market analysis.
Yeah, absolutely. So let's establish the roadmap for you today. We are tracking a company currently sitting at a $4.91 billion market cap that has, quite frankly, defied the standard gravity of the materials sector.
Oh, completely. I mean, the stock has surged like nearly 400% since April 2025.
Right, which is just massive. And our goal for today's analysis is to simplify the highly complex and honestly sometimes contradictory financial data that's driving this huge run.
Because there's just a lot to unpack there.
There really is. We're going to explore both the undeniable physical assets the company holds, but we also need to heavily weigh that against the potentially dangerous valuations attached to them.
Yeah, we definitely need to unpack that 400% surge because numbers like that in heavy industry don't just happen by accident.
No, they really don't.
If we narrow our focus and look strictly at the year-to-date performance, shares are up 184.1% alone.
It's staggering.
It is. So what is the actual fundamental engine driving that specific outperformance?
Well, the engine is basically their fundamental competitive moat. You have to understand the geopolitical mechanics to see why that moat is so deep.
Right, because of all the supply chain issues.
Exactly. When you strip away the daily noise of algorithmic trading, what you really have is a company that has strategically positioned itself as a critical bottleneck in the Western energy supply chain.
Which is huge right now.
Massive. We are in the middle of a monumental macroeconomic decoupling. The U.S. and its allies are actively trying to de-risk their critical mineral supply chains away from foreign competitors.
In a world scrambling for critical minerals, it feels like everyone is panning for gold, but Energy Fuels owns the only shovel factory in town. Is their White Mesa Mill really that unique?
Yeah, that analogy hits the nail on the head. Yes, the White Mesa Mill is a truly unique North American asset.
Okay, but why couldn't someone else just, build a competing facility?
Well, because you can't just build a conventional uranium and rare earth processing facility overnight with a bunch of venture capital. The regulatory friction is immense.
I'd imagine the environmental permitting alone would take.
Decades. We're talking about decades of environmental permitting processes, securing massive water rights, and proving to federal regulators that you can safely manage radioactive tailings for generations.
Wow, okay.
Yeah. The sheer capital expenditure required makes it nearly impossible for new entrants. But White Mesa enables low-cost processing of uranium and rare earths right now, which perfectly positions them to benefit from that U.S. de-risking we talked about.
And we're clearly seeing that leverage show up in their financial data. I mean, look at Q3 2025. They posted a staggering revenue surge of 338%.
Which is a huge fundamental inflection point.
Yeah, and their trailing 12-month revenues are currently sitting at $65.92 million.
Right, and here is exactly why that matters. The company is scaling through volume now. This isn't just theoretical processing anymore.
They're actually moving physical product.
Exactly. They recently executed on the sale of 240,000 pounds of uranium.
That's a massive amount of material to deliver into a heavily supply-constrained market.
It's a huge logistical and financial flex. But what's really interesting is how they're actively building the liquidity needed to fund further expansions.
Wait, mining and milling burns so much cash just to maintain operations? How are they doing that without taking on suffocating debt?
They are utilizing capped call options.
Okay, options usually sound like a gamble. How is that helping them?
It's actually incredibly defensive. When a company needs money, they often issue convertible debt. But if the stock skyrockets, those debt holders convert to shares, which dilutes your ownership as an existing shareholder.
Right, the pie gets sliced into way more pieces.
Exactly. So they buy a capped call option, which acts as a firewall against extreme dilution. It builds liquidity without suffocating debt, telling the market that they basically refuse to destroy shareholder value to grow.
That makes total sense. And analysts have obviously noticed raising their price targets to as high as $27.25.
Yeah, indicating strong consensus expectations for upward momentum.
It really shows that institutional capital is rewarding their balance sheet discipline.
Looking at the flip side, if the moat is so strong, why has the stock seen recent consolidation and falling volume since late February 2026?
Are investors paying for absolute perfection here? They're trading at a forward price-to-sales ratio of 40.53x. When the industry average is around 4x, doesn't that leave zero room for error?
It leaves absolutely zero room for error. A forward multiple of 40 is undeniably stretched, even for a monopoly asset.
Right, you usually see multiples like that in high-growth software, not heavy physical industry.
Exactly. And honestly, the recent data hasn't been flawless. There was a recent quarter-over-quarter revenue drop of 32.1%.
That's a significant contraction. What drove that drop?
It was largely driven by unforeseen, really complex challenges in their rare earth segments. Rare earths are notoriously difficult to separate.
Wait, break that down for me, but the term rare earths gets thrown around a lot.
Right, so mechanically they are tightly bound together in minerals like monazite. To separate them into commercially viable metals, you have to put them through an agonizing chemical process.
Like intense acid baths and solvent extraction.
Exactly. The chemistry is hostile, the equipment degrades rapidly, and it's wildly expensive. Which brings us to the harsh reality of their current cost pressures.
Margins are brutal, right?
Painful. Operating margins sit at a negative 81.6%.
Wow, really?
Yeah, and net margins are at negative 129.9%. The company recently posted a $17 million net loss on just $17.7 million in revenue.
So they're essentially spending nearly $2 for every single dollar they bring in.
Exactly. And that sparks very valid concerns about potential dilution to fund their operations.
Because eventually the cash reserves could dry up, and we can't ignore the macro picture here either. Geopolitical volatility has been a major factor.
Oh, absolutely.
Particularly the Middle East tensions. That has been heavily swaying nuclear demand and causing sudden sector pullbacks.
Yeah, when you trade at a forward PS ratio of 40, you just don't have a buffer for any sort of macro uncertainty.
Yeah. Let's break that down even further. If I'm a listener holding this stock right now, watching it bounce off psychological support around $15 to $17, what dates should I be circling on my calendar for the next 30 to 60 days?
Okay, so the single most critical upcoming event is April 15, 2026.
That's when the leadership changes, right?
Exactly. That's when the new CEO, Ross Papu, officially takes over.
And a transition like that is rarely quiet.
No, definitely not.
Yeah.
This leadership transition could be a major catalyst for investor updates on the White Mesa expansions.
Because he has to come in and present a roadmap.
Are expected in late April or May.
The scrutiny on that call is going to be intense.
Very intense. The market will be aggressively looking for proof that projected cost reductions are actually shrinking those massive negative margins.
They want actual mathematical evidence that the bleeding is stopping.
Right. And you also need to closely watch the charts.
Yeah, because a breakout past the $24.17 to $26.15 resistance level could signal a new run-up.
Especially if macro tailwinds materialize, like rate cuts.
Exactly. Cheaper capital means utilities can actually finance these multi-billion-dollar nuclear projects, which directly drives demand for White Mesa's materials.
It's all connected. Energy fuels isn't just a traditional equity play. It's a proxy for geopolitical security. The ultimate question for you to consider is, how much of a premium are you willing to pay today for the promise of a completely de-risked North American energy supply chain tomorrow?
That is a fascinating thought to leave you with, and that's the lowdown for today's market move. Thanks for tuning in. Stay sharp out there, and we'll catch you on the next one.